Sometimes with 3 or 4, say, hey, we're all here, let's just grab a conference room and sit down and talk. Well, Brazil, Russia, India, and China, they sat down and they said, yeah, we actually have a lot in common, a lot to talk about, and we added it up. We're a pretty powerful group. So they formalized it. And then in 2009, they had a summit conference, a formal summit conference with an agenda and all that in Yekaterinburg in Russia, in the Russian Federation. And they solidified, okay, we're a group, we're going to work together. And they did. And over the coming years, they multiplied numerous. People say it's the Brics meeting. They have about 190 meetings a year. They have working groups on women's rights, sports, the environment, climate change. You could go on and on. It's a very active, what they call secretariat, which is central organization. A few years later, in 2014, they formed what they call the New Development Bank, NDB. Well, what's the New Development Bank? First of all, it's got 100 billion of capital, part paid in, part callable, but it also has borrowing power with that kind of ownership and that kind of capital on the balance sheet. They've got hundreds of billions of dollars of borrowing power. They could easily get a pretty good credit rating. And the purpose is to make loans for development projects to the member countries. And by the way, there are stockholders of the New Development Bank who are not Brics, but they're kind of in the club. Well, what does that sound like? The World Bank on their own terms with their own governance. Okay, the following year, they created something called the Contingent Reserve Arrangement. Well, what's that? Again, they threw in a couple $100 billion from the members. China was the biggest contributor. Again, with borrowing power, so take a couple $100 billion times 5 or 10, that's your power. And this institution was designed to be a swing lender to members who were running trade deficits or facing a run on their currency or facing the prospect of having to close the capital account. Exactly what we saw in 1997, 98, by the way. I was there for that one. We ended up with long-term capital. Well, a pool that is a swing lender to countries with balance of payments deficit, what does that sound like? That's the IMF. So basically, they copied the World Bank, they copied the IMF. And I want to make 2 points. Number one, it's not like the Brics popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They're very methodical. So they duplicated the World Bank. They duplicated the IMF. Now they have applicants for membership. And there are, I think, 21 or more countries who have applied, well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted, starting with Saudi Arabia. Okay, so what happens when you let Saudi Arabia into the Brics, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have 2 of the 3 largest nuclear arsenals in the world, Russia and China. You have, throwing India in and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global landmass. I could go on and on. My point is, I learned development economics in the 1970s. We had something called the third world. It was Russia or, Soviet Union and the US. And then there was the third world. And all you knew about them was they were poor and, you had to get them off the runway. We actually had the runway theory of how you'd grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military, and again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the Brics. There's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, this goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics, some, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, led by China. And these are mostly Central Asian republics, including Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China. China's a member of two. Russia's the only country in the world that's a member of all three. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this thing plays out, and I'll talk about the thing, I realize we're glossing over that, but when this new currency plays out, that those other countries will join in. When you do that, and I found a really cool widget. It's a map of the world that's blank, and you can go country by country and fill in by color. Just click on it and give it a color. And I did that. And I was like, okay, here's the Brics, it's 5 countries or whatever. Well, here are the applicants, it has another 20. And here's the SCO, a few more. Some of them are members of both. Here's the EEU, has a few more. Again, many are members of both. And you keep going. And all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island, what he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is more collective economic and population power? By the way, output of wheat, pick your metric. This dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Let's just kind of digress for a second. And what are the headlines saying? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have two countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? And Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Now, Russia sells oil to China. China pays in Brics, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem. A couple of things. Number one, I would increase my allocation to cash. I'll stick with cash, but let me kind of put that in a context. The most powerful investment tool we have is diversification. Problem is people don't understand what diversification means. So I run into people all the time. They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. In calm markets, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Diversification is having slices of asset classes that are minimally correlated. There's probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. I have some strong views on gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50% in anything. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And people say, well, wait a second. Bank's paying me 25 basis points. Stock market's going up. Why would I want to be in cash? That's horrible. A couple of things. Number one, the stock market might not always go up. Cash is the opposite of leverage. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger losses. If you have a slice of cash and you've got a volatile asset over here, which are stocks, another volatile asset over here, gold's fairly volatile. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better at night. Cash is a great asset in deflation. And if you're talking about inflation, which is here, then you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or, the thing about the inflation, just a quick aside, it comes in two flavors. There's cost push and demand pull. Demand pull is when individuals are worried about inflation and they start accelerating purchases, like, hey, I better go buy that washing machine right now because the price is going up, or better go buy that house right now because the price is going up. That's demand pull. Cost push comes from the supply side, not the demand side. And that's what we're seeing because of what we talked about, supply chain, energy cost. The Fed can't drill for oil. Raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. Yeah, and that'll cool it off. But when you pay, I put gas in my car. I don't just read about this stuff. It used to be $45. Now it's about $75. Multiply that by 200 million cars across America. What happens is it reduces your discretionary income. If you're paying another $30 at the pump twice a week, then you're not going to go out to dinner Friday night. You're not going to, take a vacation, whatever it may be. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road. Not right away, but maybe next year. So cash. But here's the biggest value of cash. It gives you optionality. People don't understand this. What if I said to you, hey, I'll sell you a call option, an at the market call option on every asset class in the world? You go, gee, that sounds kind of valuable. Well, that's what cash is. When things are crashing, you're the one who can go shopping. And nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway is at an all-time high. So there's a place for that. You can have some stocks, but I would look at the energy sector. I mean, I actually built and I own the largest non-commercial solar module field in New England. And I run my house off it. It produces about 7.5 kilowatt hours. So I know a little bit about it. And what I know is it doesn't work at night. It doesn't work in snow. It doesn't work in rain. It doesn't work in really cloudy days. By the way, you don't run your house off of solar modules. You run your house off of batteries.
Yeah.
And then the modules charge the battery. So you watch the battery level. That's how you manage it. So it works fine. But if you think you can run cities with that, forget it. So it's just not practical at that scale, even if you thought it was. And it isn't. That's very clear. But here comes wind turbines and solar. And I'm not against it. Like you say, I own one. But they're not scalable. They're intermittent. And they don't give you the base power, baseline power you need to run a modern power grid. Meanwhile, here's global demand. Okay, so the gap's getting bigger. It's not getting smaller. Renewables, whatever the pros and cons, are not closing the gap. The gap's getting bigger. There is no substitute for oil and natural gas and uranium. You got to put uranium in the mix. And hydro, if you live in Quebec, that's great. A lot of hydro, but not so much in the desert. And I've spoken to, without mentioning names, I would say you can go no higher in terms of who knows, let's just say board members of the 5 biggest oil companies in the world who said, yeah, as he said, we talk about that, but we can't say it publicly because we'll be, dragged, chained and dragged through the streets. But those are just the facts. So therefore, if you have an oil sector that's been bashed by the climate alarmists, but you can't do without it, which is true, buy some oil companies, when they're, so there's your stock portfolio. Private equity, venture, real estate, not commercial, but residential, yes. And, farmland, that's one of the hottest asset categories, and gold. So that's diversification. And that's the kind of portfolio you want, you kind of season to taste. So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or Will they see that coming? They'll be the last to know. We'll all see it before they do, but they'll be the last to know. It's because they rely on flood models, and they're kind of in their own economic forecasting bubble, and they're very defective ways of thinking about the economy, and they're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the inflation. So rather than say which one's going to happen, I prefer to lay out those two paths and then just watch it very carefully. But more to the point, we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster, but this is a replay of everything that happened from 2013 to 2019 and into 2020, which was, I'll just go through it quickly. So 2013, May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever you want to call it. The market, tanks, bonds go down. Everyone's like, oh, it's over. Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that matters. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. Took 2.5 years, but they got to 2 rate hikes. But then here comes Jay Powell. And then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified it, but that would have been a reasonable level. So, okay, now interest rates are kind of normal, 2.5, balance sheets down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2018, the stock market dropped 20%. That was the December 24th, 2018, we call it the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got the message. First week of January 2019, he says, okay, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your carry trades or whatever. And then he went further, said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero. And then they started QE, I don't know, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down to $3.5 trillion. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchases. They raised rates. They sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates, and then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion after getting down to about $3.5 trillion. So that was a big circle. They ended up back where they started from. But the point being, they failed to normalize. They failed to get rates where they wanted. They failed to get the balance sheet where they wanted. They did sink the stock market. Okay, now 2 years forward, here we are again. What are we doing? They just raised rates at the March meeting. They're going to raise them again in May. And that's the easiest forecast I've ever made. 50 basis points, May 4th. Boom. You can count on it. And they're going to announce. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they're going to make in advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So they're going to raise rates again in May, probably 50 basis points. They're going to announce a reduction in the balance sheet. Whether they actually start it in May, they probably will. $100 billion a month reduction in asset purchases. So that's QT, quantitative tightening. In other words, they're running the same playbook They tried to run, or they started to run in 2013, 2014. They failed the last time. Why do they think they're going to be any more successful this time? Why do they think they can get out of this? And the answer is, pardon me, the answer is they cannot without a recession. They can normalize rates in the balance sheet and they can stop inflation, but not without causing recession and not without causing a stock market crash. So the big question for the next year is, will the Fed do that? And they may. Or will they balk again, at which point you might rescue the market, but the inflation is just going to go wild. That's the debate. But the thing is about framing it that way. You've got two paths, and we'll get signals along the way. We won't be the last to know. The Fed will, but we won't. You'll be able to see this coming. In 2020, they were back to where they started in 2013, except worse because the balance sheet was even bigger. It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly. And so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed balks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and shutting down the Keystone Pipeline.
Welfare.
All that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there is a difference between extreme recession and financial crises. They're two different things, but they can happen at the same time as did happen in 2008.
In this video, Jim Rickards talks about the challenges and potential risks faced by the Federal Reserve in managing the economy. The central theme revolves around the delicate balance that the Fed must strike between preventing a stock market crash and avoiding a severe recession. Jim raises concerns about the Fed's ability to have perfect information, citing flawed models and the possibility of being behind the curve in recognizing economic challenges. The distinction between a recession and a financial crisis is highlighted, with historical examples used to illustrate that these two phenomena can occur independently. Jim Rickards emphasizes the difficulty the Fed might face in choosing between preventing a financial crisis or accepting a recession as a trade-off. The reference to Paul Volcker's actions in the 1980s adds historical context, showcasing a deliberate choice to induce a severe recession for the purpose of combating inflation. However, Jim Rickards notes that the current economic landscape is more intricate, with additional considerations such as systemic risks and the potential for a recession triggering a financial crisis. In conclusion, Jim Rickards underscores the complex decisions the Federal Reserve must make, acknowledging the uncertainties and trade-offs inherent in steering the economy and avoiding undesirable outcomes. Before we get into the video, can you help me to give that like button a little touch? All right, let's get into it.
Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes, but the problem is it might happen anyway. In other words, they might have gone too far, and this almost happened in 2018, and that was my point. It was that by the time they realize their mistake, it might already be too late. So that's one danger, which if they had perfect information, oh, gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. We learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Oh, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit." And I granted that. I said, "You're absolutely right." I said, "Nice job. You're a stronger bank now than you were then." But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was at the time the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020 since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. Commercial banks, no one really cared about investment banks. They could fail. So what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis, but today you would be for the reasons we mentioned. So there are two possible major blunders here, but again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, it's kind of so and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
In the face of these complexities, our discussion leaves us with three potential scenarios: the risk of unwittingly tightening into a recession, the prospect of accepting a recession for inflation control, or the challenging choice of allowing inflation to run rampant. The Federal Reserve stands at a crossroads, and the decisions they make in the coming months may well shape the economic landscape for years to come. As we conclude our exploration, it becomes clear that the path ahead is fraught with challenges and decision-making. The balancing act between preventing a stock market crash and avoiding an unintentional recession places the Federal Reserve in a formidable position. The lessons from 2018 serve as a stark reminder that perfect information eludes them, and the consequences of their decisions may only become apparent once it's too late to correct. The historical perspective sheds light on the dual nature of economic downturns, where financial crises and recessions don't always go hand in hand. Drawing parallels to Paul Volcker's bold strategy in the 1980s, we ponder whether the Fed might consider accepting a recession as a necessary sacrifice for taming inflation.
The inflation peaked around 9%, but it has been coming down. It's still too high. It's still way above the Fed's target. They say we want 2%, but I've never felt that 2% was the right target for inflation. I always thought it should be zero. If you believe in price stability, you wouldn't want any inflation and you wouldn't want any deflation. You would want price stability. Now, of course, you're never going to get it exactly there, but the target in that world would be zero, maybe a little bit below, a little bit above, but you'd always be steering to zero. That means you're not stealing anyone's money through inflation. You're not enriching creditors through deflation. You're not distorting the allocation of capital by either one. You're just saying we want stable money. That's kind of the Fed's job. Then the question is, why is it 2%? And, I disagree with Milton Friedman on a lot of things, but Milton Friedman said 0. He didn't think it should be 2%. He thought 0 was the right number. I agree with that. So why is it 2%? Well, the Fed has a rationale. The rationale is every now and then you have to cut interest rates to stimulate the economy, bail out the stock market. You just need a rate cut. And the evidence is pretty good that negative rates don't work. They have been tried for years in Japan, Switzerland, I believe Sweden for a while, and the ECB, but they don't do anything. They don't stimulate. In fact, they often do the opposite of what they're intended to do. Let me give you a concrete example. So the idea is if I cut interest rates, lower and lower, as a saver or an investor, I'm going to say, well, I don't like those low yields. I put money in the bank. I only get, a quarter of 1% or half of 1% or whatever. So I'll go buy some treasury notes or I'll go buy some stocks. And that's called the portfolio channel effect. In other words, by keeping rates so low, you make simple savings and liquid investments unattractive, and you drive investors to other investments, housing, stocks, bonds, whatever, commodities perhaps. And then that creates a wealth effect. And if my assets go up, I feel more prosperous, and maybe I spend more money, and that helps the economy, et cetera, et cetera. That's the theory. It's all garbage, by the way. There's very little evidence for the wealth effect. Assets go up, people feel a little better about it, but the idea that they turn around and spend more money does not hold up. The people with the most assets tend to have the most discretionary income. And, once you got a couple of cars and a couple of houses, and a decent wardrobe, you're actually going to go spend more money. Well, probably not. You'll probably save it or invest it. I'm not saying those are bad things, but the idea that it stimulates the economy is not true. But if you follow the theory and say, okay, lower rates force you into asset purchases, et cetera, wouldn't negative rates do even more of that? Because what happens with a negative rate? You have $100,000 in the bank, and at a negative 1% interest rate, I'm the government or the treasury or the bank. I'm taking $1,000 a year. I'm taking 1% out of your account. So you're sitting there. You just say, hey, I just want to save $100,000. That's all I want. But with a negative rate, it goes 99, 98, 97. And the idea there is, well, now you're really going to spend your money because it's kind of use it or lose it. Again, these are the kind of theories, but let me kind of ground that in the real world a little bit. What do people actually think? When they see negative rates, people say to themselves, there must be deflation coming. The economy must be in really bad shape. Deflation must be getting the upper hand. Why else would they go to negative rates if they weren't worried about deflation? And if they are worried about deflation, and they are, then I'm going to save more. Far from getting people to spend, remember, the dollar is worth more. In a deflationary world, your dollars are actually worth more. In real terms, a dollar can be, just a bank account, can be your best performing investment. In a deflationary world, if you have 2% deflation, then the real value of a savings account with zero interest goes up 2%. And that's probably better than what stocks are doing in that world. So people act rationally. They say, okay, we have negative rates. Central bank must be worried about deflation. If they're worried, I'm worried, and I'm going to save more because, first of all, those savings will do well in deflation. I need to be prepared for that. The last thing I want to do is spend. If prices are going down, why would I spend? I'll wait 6 months, get a cheaper price. So, in other words, real world behavior is the exact opposite of what central bankers predict. Central bankers predict, use it or lose it. You'll go spend the money because I'm going to take it away. But real people say, no, I'm going to save more, because you're signaling to me that the value of the money is going up because you're worried about deflation. The prices are coming down, so what's the rush? So for all those reasons, negative rates don't work. Now, in theory, cutting rates from 5 to 4 to 3 to 2 down to 0 does perhaps have some stimulative effect, not as much as people think. And so the Fed says, well, we don't want to start with 0. If we start with 0, if that's our target, and negative doesn't work, and the economy goes into a recession, how do we stimulate the economy? We can't go below 0, but we can't cut rates because we're at 0. So they believe that they ought to keep rates around 2%. Now, as inflation is about 2%, interest rates are about 2%. And that gives you 2 points of cuts. You could do, in 25 basis point rate cuts, you could do 8 cuts. It's a full year of rate cuts from 2 to 1 3/4, 1.5, 1 1/4, et cetera. You could do 8, 20. Accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil, and you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices, because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They pile $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Kerry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed, it's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. A lot of people know, some people know that, some people don't, but the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate, but the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing, and if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, et cetera. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory, general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein in me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, etc. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than 1 on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. The curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%. And it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum, and rolling over the balance, and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 20, 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up, I get it, but it looks like they peaked and have turned around. So treasury notes, a good 2-year note, a 5-year note will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good, but if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So Yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so 2-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risks, stocks are coming down, then interest rates are going to come down too. If you look at yield curves, look at the Treasury yield curve, Euro dollar futures yield curve, German Bunds yield curve, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short-term rate. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Eurodollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I said, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot to say that there could be a rate cut. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes. and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level.